Hey everyone, Jason Reagan here with Leading Edge Financial Planning. Kevin and I recorded a video about ETF with ticker symbol BOXX, and I wanted to just do this quick intro just to discuss the problem that we are trying to solve with using this Boxx ETF. And that problem we're trying to solve is the excessive tax rates on interest income, which of course is taxed the same as your wage income. So whatever tax bracket you're in, whatever marginal bracket you're in, any interest income is going to be subject to that same tax rate. So in this example here, I'm assuming you're in a 37% tax bracket. Let's say an income of $700,000 a year. Now, a bank interest. Let's say you have $100,000 of bank interest. So of course, that's going to be fully taxed at your marginal income bracket. So you're going to be taxed 37% right off the top, and then you're also be subject to the 3.8% net investment income tax for another $3,800. And then if you're in a state with state income taxes, in this example, I'm using California at approximately 9.3% rate, that's another $9,300. So in the end, you're paying just over $50,000 in taxes. So you're left with essentially half of the actual income that you received. You paid just over half of that in taxes. Now, this next example is showing T-bill interest. Now, T-bill interest, and this applies whether you're investing in individual T-bills or if you're investing in an ETF that invests in T-bills, like, for example, BIL or GOVT. So all the numbers are going to be the same as on bank interest. However, there's no state or local income taxes on T-bills. So that is the big benefit of T-bills. So in the T-bill example, you're left with a total tax of $40,800 and you're left with $59,200. So you're looking at 50.1% for bank interest or CDs, or also applies to like high yield savings, or a 40.8% tax rate with T-bills. And I should make the point that if you're ever comparing interest rates between like a bank interest or T-bills, if you are in a state with state income taxes, be sure that you're also accounting for the taxation, because in some cases, even if T-bill interest is a little bit less than what you get on your bank interest, when you factor in that additional tax on the bank interest, it may still be better after tax to invest in the T-bills. It's just a side note there. So one of the benefit of the Boxx ETF is that the interest is not paid out; it's retained inside the ETF. So it basically just methodically gains in value as it collects interest, and then when you need the money, then you just sell whatever portion you need to raise the funds that you require. And in this example, I'm assuming, just like above, that we wanted $100,000. So we have $100,000 of long-term capital gains, which of course are preferentially taxed. In this example, you're going to pay 20% capital gains. You're still subject to the same 3.8% net investment income tax. Again, if you're in a state like California that taxes income, again at that 9.3% rate, that's another $9,300, no different than the bank interest. Gives you a total tax of $33,100, and you keep $66,900, which is about $17,000 more than in the bank interest example above. The $7,700 here is the difference between using Boxx ETF and the T-bill. So it's less, but it's still much better than the bank interest shown here. And using this $17,000 as an example, if you're able to invest an extra $17,000 a year, 4.7%, that's an extra $220,000 over 10 years. So it's actually a very powerful thing to be able to keep this money here working for you instead of going to the tax man. So essentially, that is the problem that we were trying to solve with the Boxx ETF. So with that, let's get on to the rest of the video with myself and Kevin.
Hello again, Jason. It's Kevin Gormley with Leading Edge. And Jason, thanks for joining us today to talk about a tax strategy with after-tax money. So anyway, as always, the big-brained items you bring up in a meeting, and then I go and I find out what you're talking about, and then I go, wow, okay, I get what he's doing here. But do you want to just start out by explaining the whole idea of why we're doing this? And also, what's the use case for this type of products? Who should care? Because we're only sending this to people that we think should care.
Well, the purpose of doing the box spreads or the box ETF, which we're talking about today, is it's a way to still receive time value of money like you would if you bought a T-bill. The problem with T-bills, and typically we use like BIL, which is a T-bill ETF, and we use that because it's easy to buy and sell. But they pay out interest, and it's ordinary. It's going to be ordinary income, and which is great. But ordinary income is just the worst. The worst kind of income is it's taxed at your full marginal rate. And if you don't necessarily need to spend that income each month, then it's very tax inefficient.
Right. So Jason, really the use case for this product, I just want to say that, what's in it for you as a client? Why would you want to use this? Well, the use case is someone that's in a very high tax bracket. And when ordinary income gets taxed, in essence, it goes on top of all your other income. So if you're in the 37% bracket, 35% bracket, when you get income from either banks or bonds, that's going on top. Every dollar that you make is getting taxed as ordinary income. If you're in a high tax state, it's getting taxed as income as well. The second issue is if you have a significant amount or some money in taxable accounts or bank accounts. If you don't have that, and even if you're high income, we do have clients that have high income and don't have any money outside of taxable accounts. So that's another use case for it. And then the other thing we'll do in this video is we'll just talk about the difference between qualified and non-qualified dividends. And Jason will go through a little bit about an education on how that works, because to me, it's not only fascinating, but it's important. So I'm going to go through just all our main points now. So why do a box spread ETF? Well, you're able to turn what's income every month, every year that you have to pay ordinary income on, and you're able to get capital gains out of this over a time period for what we consider to be a good enough reward with less risk. You're accessing box spreads, which if you want to deep dive in that, let's talk about it. You still won't probably understand it. I don't understand it well. Jason absolutely understands it, and I'll show a picture of what it is. But basically, money's coming in, it goes through the time period of the options, and then it comes back out. Professional management doing these box spreads for us, and we consider it to be very reasonable cost. So here's what it looks like for those of you that are professional option gamers here, is that you have a synthetic long, you have a synthetic short, and then at the end, you get whatever the discount rate is, as Jason said, zero coupon bonds, yada, yada, yada. But really, that's what's happening is it's going into the spread and then it's coming due. So last few things I'll say is that these are foreign options. And the reason why that's important is that U.S. options can be called. These cannot be called. So they're using S&P 500 and other types of investments. I think they're just using S&P 500 right now to write the options. But do you know if that's true, Jason?
Yeah, it has to be European style options that cannot be called earlier. Do not to try and construct your own box spreads using American style options that can be exercised early, because that could be catastrophic. If a certain part of your box spread got exercised, then it is no longer a risk-free position. In fact, it could have massive risk.
Absolutely. So they're not giving it away. There is a fee for this. Okay, so let me show you the usual. And so we'll start out here with BIL. Again, it's 1 to 3 month T-bills. It's riskless. 90-day T-bills or less are considered riskless. So you can see the return year to date is 2% on bill. 1 year, it's 4.64. The expense on BIL is 14 basis points or 0.14%. And the tax drag is high. Okay. So what it looks like here is over the last 3 years, Bill has done a positive 14% return. You can see the different years. Now I'm going to put in a box and then I'll bring Bill back into it, but I want you to see since it launched. So this is the max time period now. It appears it launched in December of 2022. So we have 23, we have 24, and we have now so it's actually 2.5 years. I misspoke before. This is a little bit less of a time period. So the 12.19, when we compare this to BIL and we use the same time period, what you'll see here is that the lines really are on top of each other. And BIL has a little bit less return. When I asked the gentleman that runs the investments at Alpha Architect, he said they're going to get the return of the T-bills. And he said plus. He goes, the plus part we don't know. I'm usually skeptical when I hear that, Jason, but 2 years out of 3, they did get the T-bill plus. So that did actually happen. And again, these lines are on top of each other. There's a high correlation. The part that the expense, again, is 0.19 versus 0.14, that to me is not meaningful. But the really interesting part is when we look at the price of Boxx, the price actually has gone up. So this is where we have that capital gain issue here, that you're not getting paid out anything. The price is just going up. And then when I put Bill in here, what you see with Bill is the price doesn't change at all. And that's because of what Jason said. It's just paying dividends over and over again. Okay, like we talked about, this is for higher income people, not necessarily wealthy, but higher income people. And this is one of those first world problems, which means that we're supposed to feel a little bit guilty about having this problem. But anyway, we don't believe in that. We don't believe in the guilt. So let's say, for example, we have somebody that's making $700,000 a year. Jason, this is not really our pilots, but we do have physicians that are making this amount of money. You get taxed at the 10% bracket, the 12% bracket, the 22% bracket, the 24% bracket, and then the 32% bracket if it's married filing jointly. So the average tax that this individual is paying is 27% because you're going through all of these brackets. And so the last dollar is taxed at 37%, but you're actually paying a 27% tax on average. So I think that's the first really important thing, is that the money you earn from work, a lot of it is taxed at lower than 37%. But when you make money in bank interest, and we saw some clients make a massive amount of bank interest last year, and all of that is actually taxed at the highest rate, which is 37. So you might consider that you're paying more tax on your investment income than you're even paying on average on your income from work. Any comments on that, Jason?
No, I think you hit the nail on the head. It's just that your interest income that's going to be last dollar stuff. So it's always going to be at the highest applicable tax rate.
So in this case, $100,000 of ordinary income or bank interest or bond interest, $37,000 of tax. But wait, there's more. Once you make over $250,000 married filing jointly or 200 single, you also get the super bonus tax, which is the net investment income tax, also known as the Medicare surtax. So you are paying extra because of this net investment income tax. So really the total tax that you're paying is $40,800. That's a tax rate of 40.8%. Again, if you're in a state, might even be higher. And so the way I think about this, and this is not to make any of us angry, it's just, as they say in New Jersey, Jason, it is what it is. You're taking the investment money and you have to share almost 41% of it with the U.S. government and even more with states. So I think this is the problem. Is there any other way to frame this in your mind, Jason?
No, it's important to know too, if you buy non-treasury bonds, you also have the state tax on top of that if you're in a state that has an income tax.
That's right. So you can buy T-bills and not have state income tax. Thank you for that. That's really important. So now with Boxx, just take my word for it, and then Jason's going to show you that it's true. If you were to hold this investment Boxx for a year and a day, and you had $100,000 of income from it, and that is, it went up by $100,000 a year and a day, then you would pay only capital gains on the amount that went up. And so $20,000 would be the 20%. Again, you have the super bonus tax, as I said up here, the net investment income tax, 23.8% versus 40.8%. And you get to keep a lot more, Jason. So with that, and we do think there's a future value. We'll come back to that. And the amount of tax you're paying during the years versus if you could save that tax and keep on reinvesting it. So any other comments before we jump into your fantastic visuals on the difference between T-bills and Boxx?
Nope. I'll go ahead and share my screen. And I want to talk about a little about what actually is a Boxx spread. So a Boxx spread is an options trade. I know a lot of people get scared when they hear the word options, but options can be as risky or as conservative as you want them to be, depending on how they're set up. So a Boxx spread is an option strategy, and we don't need to get into the mechanics of exactly how the trade is constructed, but it's basically, for anybody that's knowledgeable about options, it's basically combining a bull call spread and a corresponding bear put spread with the the same strikes, the same expiration dates. The net effect of is it's essentially a riskless position. And so if you buy a box spread, and you can buy a box spread on your own at any brokerage firm, you can configure this box spread yourself. You know, any financial product has a discount rate built into it. It's just no different with options. So if you buy a box spread, you're essentially, it acts like a zero coupon bond. So the value of the spread at expiration is going to be just the width of the strikes that we've chosen. Say it's $1,000.
Yeah.
And so you're going to be able to buy that $1,000 spread essentially at a discount. Say you want to buy a box spread that expires in 3 months. You can buy it, say you can pay $950 for that spread, and then 3 months from now it's going to expire and you're going to get $1,000 back.
I know that was easy for you to say and understand, but for the other 98%, well, Jason is an engineer by nature, so he really is very specific with how he thinks about it, and that's why he brought this up. But basically what we're saying is that you have a sum of money, you put it in a box spread, or you put it in a T-bill. Both of those are going to bring you the same return. It's done with zero coupon T-bill type thing, but really it's the same thing, right? 90-day bond or 90-day box spread, you can get the same return.
Yep. And of course you can do a year box spread, it'll pay no interest in the interim and you'll get it all at the end. So just like a zero coupon bond. Yeah. So this chart here is a chart of BIL, which is something we typically would have recommended. It's just an ETF that consists of U.S. Treasury bills, and it pays out a dividend every month. And you look at this chart here, and it's just a time chart going back 1 year. And it looks very weird, right? You see the lines going up. And so you can see like in between during the month, it goes up and then it declines. And that decline is when the interest is paid out. And technically it's a dividend because it's coming from the ETF. But think of it, when I say dividend, essentially meaning interest in this case.
Yep.
And of course, just like with a stock, whenever something pays out a dividend, it decreases. The price decreases by that same amount. If it didn't, then of course there'd be a huge arbitrage opportunity there. An efficient market, this always is going to occur. So what happens with BIL is over the long run, you get no price increase. All the gains are paid out to you every month as a dividend / interest, and you have to pay income. Even if you reinvest it, you have to pay tax on that dividend, and it's going to be taxed, as we've already discussed, at your ordinary income rate.
So let me pile on here, Jason. Dividend is not created out of air. It comes out of the price of the investment. The price of the investment goes down, then the dividend's paid, you get the money. If you reinvest it, again, the dividend came out of the investment. So it's a zero-sum gain. The dividend built up over the month, and then you get it paid, and then so you don't get any price appreciation. You just get the dividend or interest.
A good way to think about it is if this did not happen, I can show up on the last day of the month, buy BIL, and collect, a 5% annualized dividend with no risk.
That's right.
Collect that dividend, sell it the next day. So it has to be this way.
So Bill, we see the squiggles of the dividends being paid and the price never goes up. What's the next chart?
The next chart I'll bring in is the chart of actually Boxx.
Okay.
And so you can see the chart looks way different, right? It's just a steady, almost perfectly sloping line up and to the right. And side note, if you reinvest the dividend from BIL, it'll look very similar to this chart. However, in the case of BIL, you're having to pay taxes on the dividends each month. In the case of BOXX, it's not paying out any dividends or interest. It's just accruing inside the ETF, and the taxes are not due until you actually sell the ETF. And that's where the hopefully long-term capital gains comes in if you hold this for more than 1 year, or a year to day, as you said.
Yeah. So really what we're saying is that if you own BIL, you're getting those payments, you keep reinvesting it, it would look just like this. With Boxx, every time the Boxx spread comes due, the money just goes into the price. And so with ETFs, you're able to swap things, and that's the reason why they're able to do it. So you're not buying and selling, you're not getting an interest payment. The value of the investment is just going up. And therefore, we as investors control the nature and the timing of that tax. If we decide to sell it before a year, yes, it will be short-term gains taxed exactly as it was before. But if we hold on to it a year and a day, it will be taxed more favorably.
Exactly. And Boxx did pay out a small distribution last year. So it's not like a guarantee that it's never going to pay out any income but their stated goal is to minimize it to the maximum extent possible. And like I said, I did pay out a small distribution last year, but it's very tiny compared to what something like BIL would have paid out.
Okay, Jason, let's talk about what could go wrong. There's a famous saying in investing, there's no such thing as a free lunch. That's probably with other things too, but especially with investing. So if something is different, it's not the same. So what are the things in your mind that could go wrong with using this product? Is it the same risk as Treasury bills, or is there a little bit more risk here?
I would say that there's definitely a little bit, slightly more risk. And historically, this Boxx ETF has paid out a little bit higher rate than what you would get in Treasury bills. The firm that puts it out is Alpha Architect, and they're a very reputable firm. So I don't have any concerns. One concern would be like they just screw up the execution of these Boxx trades, but I don't think that's a material risk. The other issue would be possible counterparty risk. When you buy an option, there's somebody selling you that option, and the guarantor of all that is the Options Clearing Corporation, OCC, which has been around a long time, and it's as financially strong of a entity as you can find. Maybe not quite on par with the U.S. Treasury, but so I view the counterparty risk as very small.
Yeah, Jason, let me jump in here because
Yes.
people don't know what a counterparty risk is. We heard it back in 08, 09, but really the counterparty, when you invest money with the U.S. government, the counterparty is the U.S. government. You loan money to them. If they don't pay you back, that's the counterparty risk. With the Options Clearing Corporation, you're forming this Boxx spread. And if the Option Clearing Corporation couldn't exist, then that's the counterparty risk. And the Options Clearing Corporation, my understanding is it's AA, and I have a slide on that and I'll show in a second. The U.S. government, I don't know if it's AAA anymore, but
I don't think they are.
It's a little bit better. But really, the OCC, Options Clearing Corporation, is considered to be a systemically important financial market utility. And this is a thing, okay? All of these are all those things, the systemically important financial market utilities. And so if we have a massive disruption, these are, too big to fail, if you will. Down here, you can see some of the banks, and some of the banks were bailed out. JP Morgan Chase, Bank of America, these are not systemically important financial market utilities. So let me just go back here. And this is what we were talking about here. If you loan money to the U.S. government, it's AA plus from S&P Global Credit Ratings. If you have money go through the Option Clearing Corporation, it is AA. So potentially there's a little more risk there. Jason, I think we've said it before. If the Option Clearing Corporation goes belly up, we probably have a lot bigger problems because it has to be a massive failure of markets.
Oh, yeah, I'm sure if that were to happen, then all your other, holdings, equities and whatnot have probably, had serious issues as well. So I should point out, I've held Boxx myself for over a year now. And one of my rules is, I'm not going to invest clients' money in something I wouldn't put my own money in. So I did a test on it, and I've held it. It's been over about a year and a month now since I've held Boxx, and it's done just like it's been advertised.
Yeah, and the product's been out for, I think it's 2 years now, if I'm not mistaken, Jason. But let's talk about the risk of messing things up. I did go online and I did a search on how to create your own Boxx spread, and everybody was saying how easy it is. It's so easy. But then when I looked at how to do it, I was like, that ain't easy. So it's probably easy for mathematics, heavy geeks, stuff like that. And the people that run this, I did talk to one of them, and they're both, mathematic majors and that kind of thing. And so I think it's pretty easy to do. And so I don't see that much of a risk in that, but that's always a risk as well, is that they do it wrong.
Another risk to point out, or a possible risk, is there's been a little bit of tax controversy with this ETF, and that somewhere in the tax code, and I've read a little bit online about this, but anytime you're receiving interest, like essentially risk-free, which essentially is what a Boxx spread is, if you have no principal at risk, it's supposed to be ordinary income. But in this case, if you hold this ETF, of course, for more than a year, you're able to get long-term capital gains. So it could be possible that at some point, maybe the feds decide, the Boxx ETF, you now have to pay out that option income. Then you're still not going to be any worse off than you would have been if you bought BIL. So it's just, you're going to be taxed at ordinary income on that, and you're not any worse off. I don't see that as a material risk, but maybe if the ETF gets big enough, somebody will care, but it's not
Yeah, so
something.
I see that as probably the most likely thing that could happen compared to the OCC and compared to messing up the box spread. But all the ETFs right now, the reason why ETFs are so much more tax efficient is that they all have the ability to swap out trades. And that's how the Boxx ETF is doing it. They're never actually realizing taxable income. So, but Jason, we always like to point out the risks, no doubt about it, because we feel this thing is super safe, super safe. It's not as safe as Treasury bills, but we feel like it's super safe, but there's always risks.
Yeah, I think it's to point out that we're recommending Boxx ETF for taxable brokerage accounts. Like if you're holding this, if you want, treasury income in like an IRA or 401k, then we would recommend sticking with BIL, but we're specifically referring to taxable accounts.
Right. And we're not saying that all your money has to come out of the bank and go into this, because again, you have to hold it at least a year and a day. But we think that this is part of the risk return. And to come back to our original, what's in it for you and why might you consider this? So the benefit here, risk benefit is always important, Jason. So what you keep here is 59,200, like we said. What you would keep with the box spread, if you held it a year and a day, you keep 76,200. So the difference between these two is the amount, just by using the different investment, how much more you will keep. And so is that reward worth it? We think it's probably worth it for some portion of your money. But to me, the more important part of this is that year after year, you can avoid the income tax. You would be able to reinvest that. And here I just said, let's pretend it's a 10-year time period and you're saving $9,500 on tax, just for laughs and giggles. And the interest that you're getting is 4.7. That might be a little high today. You're doing it every year. Well, the future value, if you keep reinvesting the tax savings, would be $138,000. So even though here it's, and I'm going to say only, that's kind of laughable, but it's only $16,000, $17,000. The reinvestment of that money over time can make a huge difference. Final comment, and then I'll turn it back over to you, Jason. You could also be, age 65 or age 70. And if this box continues to work like this for the next 20 years, you could die and leave a step up in basis because you decide the nature and the timing of when this is going to happen. And your kids would not have to pay any income tax on it because of the step up in basis that we have right now.
Yep, it's important to point as well. And I think my final comment is just, this is not a recommendation for anybody to go out and buy a Boxx ETF. This is strictly for your own knowledge and something to speak with, myself or Kevin or Charlie, your own advisor about possibly using this product. You don't rush out and buy this product just because of this video.
Absolutely. But, really, this is a very interesting product to us because it really mimics what you can get from Bill. And the tax benefits are just tremendous. So, Jason.
Tremendous.
Final comments. You have the con.
No, I think Boxx is a great thing, potentially for somebody.
Potentially.
Who's tax sensitive, like anything. You don't have to make an absolute decision of all Boxx or all BIL. If you have money in a taxable account, you think you're going to need in 6 months from now, well, then you won't get a benefit from Boxx. So I would put that money in the BIL probably, and then, but
or the bank,
any money that you want to receive, T-bill interest on and you anticipate not needing it for more than a year, then maybe Boxx would be a consideration for you.
So I just want to pound the table here and say that, if you have money in the bank and that money is short term, don't worry about this. But once you get out of the safety zone and you're going to hold cash for a long period of time, it could be bank, it could be in something else. That's where this can replace it. So it's not just if you're holding treasury bills. The majority of our clients, Jason, don't hold something known as a treasury bill. They hold a money market or bank interest. So that's why I say have enough money to feel good with your short-term security and then consider this product. So thank you so much, Jason. Appreciate you joining once again.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.